Sir, morning. Good afternoon, sir. Good afternoon, sir.
Yeah, 5, Vasu.
Yeah, we will wait, Sridhar. So not at 5, Sridhar. So okay, start பண்ண பண்ணிடலாம். Huh? I think the
I
speakers
think you are in mute. So Vasudevan,
Yes,
so
Sridhar.
Vasudevan,
Yes, Sridhar, you can start.
you are in mute.
I unmuted.
Sir, I am able to hear him, sir.
Yeah, start the proceedings.
Yes. Good evening to
You are in
all.
mute.
Am I audible now? Not at all.
Sir, Vasudevan sir is very much audible.
Yes, sir, you're audible.
ஏய் ரெண்டு செவடனுங்க பேசிக்கிட்டா எப்படிடா இருக்கும்?
ஸ்ரீதர் உனக்கு கேட்கலன்னா யாருக்குமே கேட்கல.
Bhaskar is able to hear me.
எல்லாருக்கும் கேட்கறதுப்பா.
Sridhar, you have to.
Charger. Charger.
Okay. Right. Good evening to one and all. This is the 5th study circle meeting for this year. And we are in the 4th part of the lecture series by Mr. T.R. Srinivasan, Chartered Accountant. Earlier, we had 3 parts in which Mr. Srinivasan has dealt with one taxable event on GST, scope and classification of supplies, taxable persons and registration. Today, in the 4th part, Mr. T.R. Srinivasan is going to deal with time of supply and when GST is to be paid to the government. And we have the second speaker for the day, Ms. N.V. Lakshmi, advocate. She is going to deal with recent amendments in taxation of charitable trusts. First, we will go to Mr. T.R. Srinivasan, Chartered Accountant. Sir, Mr. Srinivasan.
Yes, sir, I am there.
Yes, Mr. Srinivasan, yes, you can take over, sir. You can start, sir.
Yes, sir. So the thank you so much, RBA, for this opportunity to share. Last session was an in-person session, and probably we had the opportunity to see more practically in terms of the ramifications of GST in a different angle altogether. As to say that it was a all-pervasive, all-existing truth. So probably maybe philosophical, but then that's how the GST has been to some extent, that it has been all-pervasive and also all impactful truth. And in this regard, we also discussed that who is liable. In general, we find that the supplier is liable, and we also find that in some cases the recipient is liable. That was a discussion we had in the last. So till now, that the trajectory has been on what it is liable, which is basically the supply. And in this context, I just quick 5 minutes. I'll just give a what we discussed, a recap, so that it will be easy for the next discussion. So we discussed about a supply, and in this context, the most important discussion we had was the decision of the Supreme Court in the context of Madras Port Trust versus Tamil Nadu. So which also talked about the definition of business. It was, though it was in the context of sales tax, that the decision still holds good valid even under GST. So that was a starting point. So that talked about supply, and you name anything in the course or furtherance of business falls under the definition of supply. And ultimately or finally, there has to be an underlying business should be there. That's the fundamental crux. Then we said, having a supply, the next could be who is liable to make the payment for the GST. And there the law made 2 distinctions. One, in many cases, the supplier is liable. That's the default rule. In few cases, they said the recipient would be liable. Like even take the case of the advocate's profession. the advocates are not liable to pay GST, whereas the recipient of the services, who happens to be a business entity, they are liable to pay GST in this regard. So they made distinction for certain services where the recipient is also made liable to pay GST. And many cases, the supplier. The next discussion we had was about the classification. Being a supply, the next question is it goods or services? When they introduced GST, the objective was to bring sales tax, excise duty, service tax all under one umbrella. But then what has happened is, though the objective was to have a single levy, there is still a dichotomy, there is still a distinction between goods and services. So the fundamental objective which the law wanted to achieve by having a uniformity on rates, or at least goods and services, still continues. I mean, there is a problem. I would not say the problem, the objective is not fully achieved. The sense that though across India we have single rate of taxation with respect to GST, and even that is under a lot of dispute because of the considerations of say GST Council, its powers, etc. The fundamental dichotomy was goods versus service, whether software is a product or software is a service. This matter had been a lot of debate, and finally it was settled. Package software should be treated as goods, and then whatever you do associated to that should be treated as service. That was the final Supreme Court, and this itself took us about 20 plus years. So there was always a question of whether something will attract a sales tax or a service tax. A restaurant was attracting a sales tax or service tax, both started levying it. So that's where GST said we'll eliminate that distinction and bring a single law. But then in GST also, we still continue to have this dichotomy. And I'm talking about it in terms of classification, that there is still distinction between goods and services. And what is a good and what is a service? Still, there are issues with respect to certain commodities. In certain cases, there are disputes going on. And why that is relevant? Because the rate of tax changes. Something is a product or something is a service. So, for example, leasing of motor vehicle will be treated as a service in general. I mean, earlier there were a lot of issue about whether VAT should also be levied because of the transfer of right to use. But then finally it has been settled that it should be treated as a service. As far as GST is concerned, leasing is treated as a service. However, if you look at copyrights, like there is an IPR transfer. So IPR, intellectual property rights, there are two views are there. That is, in intellectual itself, you have goods also says supply of intellectual property rights. Services also says supply of intellectual property rights. So again, there is an issue. And whether it should be liable for sales tax or should be liable for the GST rate as applicable for goods, or it should be applicable for the GST rate as applicable for services, that becomes an issue. So because of this, the dichotomy between goods and services tax, goods and services continues to haunt post GST also, and we'll find so many issues coming up as regards this. As simple as, let's say, Bitcoin is sold. So whether Bitcoin sold as a goods or a service, whether it's liable for GST or not in the first place. So I'm just giving examples where GST continues to be there. Now online gaming became an issue, and that has been settled that it has to be liable for GST at 28%. That's a recent notification. So largely there is dichotomy of goods and services. Now because of this, what happens is the timing of payment of GST also differs. For a good and service, in the old law, there was a different method of taxation. For example, services is largely intangible. So government wanted to exercise or control the GST service tax collection. They said, for services, we don't wait till you raise the invoice. You receive the money itself, you have to pay service tax for it. So basically on advances, we have to pay service tax. Whereas sales tax is applicable only when goods are sold. Basically transfer is made and invoice is raised for the same. So even for advances, there was no sales tax. The same principle continues in GST also. So in GST, they have now kind of said that whatever we continue in sales tax will continue in GST. So which means in case of goods, you have to pay GST. There is a provision is there. So till now, whatever we had kind of discussed is section in order of GST, what we discussed was till section number. This is just a summary of what we discussed till date. So we had discussed about section 9, which talks about when GST is applicable. Then on what it is applicable, that is supply and classification rules, that is section 8. Then who is liable was the last discussion, which was taxable person is liable, and registration is closely connected to taxable person because anybody who is liable to register is a taxable person. And registration, we have two limits of 20 lakhs and 40 lakhs. And the 20 lakhs, 40 lakhs calculation itself is a little very expansive calculation that we had discussed. And the next one, which we are going to discuss today, is about when we have to pay the GST. That's the time of supply. And this is covered in GST law between section 12 to section 14. So only 3 sections which talks about time of supply. It only says when supply is deemed to have been done. When is that activity is considered to be done? Let me give an example. You can also share your inputs on the same. For example, let's say as an advocate, I have taken up the case. Like the client has come to me and I have briefed I got the briefing from the client, and I also got the engagement letter, and probably the wakalatnama, the authorization has been given to me. So to appear. So that is the event number 1. Now the next, I appear for the case. So that is the event number 2. Now I prepare the draft and then I appear for the case. That is event number 2. And I may be multiple hearings involved, event 3, event 4, etc. And then I receive the fees also. The events, assuming I receive the fees after the appearance is made, and I raise the invoice in this regard. So there are multiple events which are happening with respect to the same transaction. So there is right from engagement to appearance to receiving the fees. So many events are there. So government says we can says we cannot we can't wait. Supply is something which happens all through. Then when is that you are liable? So the government has made it clear in 12, 13 and 14 that for a service provider, you are liable to pay GST the moment you receive the money from your customer, or the moment you raise the invoice to the customer. Any one of these two, whichever happens earlier, you are liable to pay GST. So basically invoice date or payment date, whichever is earlier, shall be the criteria to decide where the liability to pay GST as regards services are concerned. So very simple rule that either invoice date or payment, whichever happens earlier, from that day you are liable to pay the GST. So that's what they made it very simple. However, there is every possibility that you may delay the invoice. Probably for various reasons, the invoice might get delayed, or we may send an estimate initially and then it may be converted to an invoice later based on the payment, etc. Sometimes payment may be bad debts, like you may not recover the payment also. So you may end up not raising the invoice also. So there are various situations possible. So the government has given a timeline. They said the moment you complete the service, from completing the service within 30 days, you are required to give an invoice to your customer. So they have given a timeline of 30 days to give invoice to the customer. In case if you don't issue the invoice within 30 days, then it is deemed to be liable for GST from the date of completion of service. So date of completion of service is quite theoretical, in the sense that practically identification may be a challenge. But then what is happening is the law has codified this way. Within 30 days, you have to raise the invoice, in which case invoice date will be the criteria to pay GST to government. If you don't raise the invoice within 30 days, then completion date will be considered as the criteria to pay GST to government. Before all these two events, you got the money from customer, like you got the advance. Then advance date will be considered as a criteria to pay GST to government. So put it's invoice or payment, whichever is earlier. If invoice is within 30 days, it's beyond 30 days, then we have to go based on the criteria of completion. Now, there are possibilities where it could be a case of continuous services. Let me give an example of construction service. There may not be, completion at all immediately. It may take even 2 years, 3 years, 4 years, etc. So the law has said in which case you go based on section 14, which is milestone-based completion. That is, you don't wait for the physical completion to happen. As per the agreement, whatever milestones defined in the contract, basis the milestones, you have to raise invoice and pay GST to government. So there are two scenarios they have visualized now. One is a normal service which does not require a long period. And what is long short? Again will be a dispute. So the government has said 3 months as a cutoff. So if as per the contract, somebody needs 3 months or less to complete the contract, normal supply, section 12. If it is as per the contract, it is going to take more than 3 months to complete the service, then it is continuous supply, goes to section 14. So in which case, normal supply, wait for the completion, raise invoice within 30 days, you pay GST to government. If before this you got the money, pay GST to government. Basically, government wants money. Whichever event happens earlier is up to the individual, but government needs the money at the earliest point of time. More than 3 months, you are going to wait. The contract itself is more than 3 months. And then you are going to raise the invoice, in which case they have mentioned that timeline based on milestones. Construction, let's say first floor is over, then you are liable to pay the money to customer. The customer is liable to pay the money. Then you have to raise invoice, pay GST to government parallelly. So we do not wait for the physical completion to happen at the end. We wait for stage by stage completion. So this is for services. For goods, it is quite simple that you have to pay GST the moment you are raising invoices to the customer. Simple. There is no question of advance, etc. So in services, they are given two criteria: invoice or payment, whichever is earlier. For goods, though law has said that invoice or somebody, it's very critical for them to know, will they fall under goods or will they fall under services? Especially because this is going to be a determining factor to pay GST to government. So this is a critical scenario to be looked into. Now, why it is important? Now, the next question is some of the often repeated issues which come up on time of supply is with respect to bad debts. Let's, for example, I have raised invoice to my customer plus GST, but because of poor financial, whatever reason, I did not get the money from the customer. Let's say bad debts, it has become bad debts. Now, question that arises is, because it is bad debts, can I get back the GST which I paid to government? Can I have answers from the people audience? So,
can you repeat the question?
For which I paid GST.
Srinivasan, the audio is not continuous.
So should I?
There is no audio from you, Srinivasan.
There are now cases where the customer, so whether the supplier
Srinivasan, there is no audio from you. So Srinivasan?
Sir, am I audible, sir?
Now it's coming.
Yes. Now it's coming.
Yeah. Sorry, so just some network issue. So the question which we were putting forward is, in case of bad debts, do you have a recourse to the, in case of bad debts, income tax law, it allows a deduction subject to conditions. Now, do I have that benefit under GST also, where because of bad debts, I didn't recover the money from the customer. So I pay I also tell the government, boss, I didn't get the money. There's no economic benefit for me. So there is no GST liability to the government. Anyone answers?
No refund, sir. You can't claim refund or whatever you have paid, it is paid. That's all.
Yes. So bad debts is there are only few situations which allows the money to be recouped back. I would say adjusted by the supplier from the government. But however, bad debts is not the criteria at all. So the moment there is a supply, that there is a contract, there's a performance of the contractual obligations, and there is as per the contract, we are supposed to raise the invoice. You delayed the invoice, whatever it is, as per the law, once 30 days is over, invoice is to be raised. So if all these are satisfied, supply is made, and hence it is liable for GST. So bad debts is not the criteria to avoid GST, or rather whatever paid GST cannot be claimed back. Absolutely correct. So there are only few situations where the law says that you are allowed to recover back the GST which you paid to government. Basically, you can adjust the GST. So, but those situations are primarily related to commercial negotiations and where you have reduced the prices because of mutual agreement, or because that there's a problem in your service quality or product quality, and hence there's a corresponding reduction in the service value. So these could be the reasons to decide where there is a benefit can be get back from the government. But as regards the fundamental issue of bad debts, it is not possible. So that is the one issue which comes up as regards the time of supply. The second thing which comes up is with respect to the identification is a challenge, because practically speaking, the only revenue loss for the government primarily in this case, in fact, it happens in two ways. One, for the government, it will be an interest loss when there is a delay in identification of the taxable time period. For example, invoice is raised in the month of June, whereas the payment is received in the month of September. It means there is a time gap. If this interest liability may also kick in. The second issue which also comes out is especially on the case of time barring issues. So when I say time barring cases, it's quite important. The time of supply may become a very crucial factor. Sometimes, some of the provisions in the GST law, it is codified as it is, and sometimes the time of supply also decides the time barring cases also. In GST law, we all are aware that there's a time limit of 3 years, normal time period, and then the extended period of 5 years is given. That is from the due date of filing the annual returns. So that is the criteria they have given. So from that period, within 3 years or 5 years, they have to ascertain the relevant periods. No orders has to be passed. It's not even the notice, order has to be passed. And only for 17-18, we have been consistently repeating that only this September 30th is the time to issue the show cause notices, and December 31st is the time period to pass the order. In fact, we find in practical terms that many of the assessments or audits at the department level, both at the state or center, has been going on even till today. So we are looking at about 1.5 months, not even 1.5 months, for time barring of normal time period for 17-18, and we still have a lot of audits still going on under progress. So you will have a lot of probably cases which are coming up merely on the time limit and the time barring, probably next 1 or 2 months. After that, all these issues will start cropping up. That will be the first period where the time barring is getting over, and that's where we find there could be time barring issues coming up. Now, let's say a case where the completion happened in the month of March 23, whereas the invoice was not raised for various reasons. It was missed out to be raised, and probably the payment has also not been made because there was no consideration received. Let's take the example of a case where there is an invoice, there is a completion done, and based on the completion being done, the recipient of service, this has been the issue in many cases. Even in service tax period, we find these issues. That is where I have not raised the invoice. It is under work in progress, or it is completed but not billed, basically unbilled revenue. But my customer, for the purpose of claiming income tax expenditure, he claims it in his TDS as a deduction. Like basically, he deducts TDS in his income tax TDS returns. So basically, that comes to me as TDS in my Form 26 AS. Now, many notices had been issued by the department, comparing even now in GST, they just started it few months back, by comparing my liability between what I've disclosed in my GST returns versus what is available in my Form 26AS. Though there have been precedents which says that by itself cannot be the basis to issue a show cause notice, leaving aside the jurisdiction of the show cause notice. The first issue which comes up is the issue of time of supply, because now in those cases, let's say March month I have provided the service and I raise the invoice in the month of April. Within time period also I may issue the invoice, whereas my customer would have deducted TDS reflected in my Form 26AS in the month of March itself. There have been notices issued saying that there is a difference which has to be addressed, saying that I raise the invoice subsequently. Let's say another case where TDS has been deducted and paid by my customer, and it is reflecting in my Form 26AS, which evidences that there seems to be a contract between me and that particular customer. But I have not raised the invoice, I have not paid the payment because of the reason that bad debts has happened. Money is not recovered, some dispute, so money is not realized. So in this case, if the department identifies this issue, it is liable for GST, no doubt. However, what is the time period will become an issue, because once I don't raise the invoice, automatically the law says that if within 30 days the invoice is not raised, then the law says you have to go based on the completion date. I'm talking about the service contracts. So we have to go based on the completion date. So if completion date happens to be in the month of March 2018, whereas I forgot to raise the invoice itself, time barring will count from March 2018, financial year 17-18 period, and not from 18-19 period. So sometimes time barring provisions will also be impacted because of the time of supply rules. So the time of supply basically talks when we need to pay the GST. Now the next point. Yeah, so there is one question which was put forward in case of bad debts, that what if, let's say, assume a case where I estimate the bad debts that's pending for a lot of time, I have not received it. So before the next year, I kind of issue a credit note, like against that invoice, I give you a contra credit note and cancel that invoice. Would that be okay, or whether that is proper? As per the law, the credit note can be issued only for 3 purposes. That's what I was telling, that only in certain situations credit notes are permitted to be adjusted for. The credit notes can be given with respect to the 3 situations. One, if there's a rate reduction, which is agreed rate reductions, or if there is a quality dispute in your service and hence the payment is not granted, which means you have to evidence that there is a quality dispute, or basically you are charged a higher rate of tax and you want to reduce the rate of tax. Only these are the situations where it is considered to be a eligible transactions for credit note. So bad debts is not falling under any of those situations. So legally speaking, that cannot be the basis to decide. Or if the bad debts is because of these reasons, yes, fine, credit note can be given. Otherwise, credit note can be given for bad debts. So this is to understand about the credit notes versus the invoice. So the invoice defines the time of supply, the time barring, as well as with respect to the overall liability to pay. The next question that arises is when GST has to be paid to government. I mean, you can't pay tax to government every day. That's not practically possible. Income tax, you have advanced tax dates, and then you also have you can also pay income tax any date. The law does not state you should pay only this date. It can be paid across, but they have defined cutoff period for calculation of interest, etc. So same way GST also can be paid on any day. Nobody can stop you from paying GST on any day. But then what is the statutory date for payment of GST? That is a question which has to be also addressed along with the time of supply. So can you just, this is a general question. Most of you must be having this, of course, the understanding of this. So what is the normal due date for payment of GST? Anybody who can answer. So what is the due date for payment of GST? Which is because time of supply has to happen. That is, once the time of supply is made, once the supply is made, and when the supply is considered to be made based on invoice or payment, whichever is earlier, the supply is considered to be made. Once that is made, the next question would be about what is the date on which I have to actually pay to the government. So, in fact, you'll be surprised that there is no specific section which talks about payment. It does not say this is the date on which you have to pay. For example, we all practically may know that GST has to be paid on next month. Normally 20th of every month we make the payment. For example, if it is August month, we are actually on 19th. So by today or tomorrow, by tomorrow 20th August, people have to discharge the liabilities of July. So July is discharged by August 20th. So this is the cutoff time which they keep. But where is this mentioned in the law? Is the next question that arises. Where is it mentioned that 20th of every month is the date on which payment has to be done? This is not directly mentioned in the law. It is linked in one particular section, section 39. Section 39, which talks about GST returns. Okay, in that GST returns, we'll see that later. There are three types of returns. There is one return which is called GSTR 3B returns. That 3B returns will have a summary of all the output tax liability, input tax credit, and net liability. So this is what basically a summary return, which talks about output tax, input tax, net tax we have to pay to government. So this 3B return has to be filed as per section 39 of the GST law. And in that one subsection 7, which actually does not, the section per se does not deal with payment, but only 39.7 says that whatever due date as applicable for the GSTR 3B, whatever tax as assessed in GSTR 3B shall be discharged on or before the due date as applicable for the return. This is basically 3B. Earlier it was 3B. There are so many issues with surrounding that. But fundamentally what we are looking at is 39.7 is the only place which says that you have to pay the GST of a particular month as assessed in your 3B returns by the due date of the 3B returns. And normally due date of 3B returns is 20th. By rules, they have given different dates for different turnover of tax periods. For some people it is 20th, some people it is 22nd, for some people it is 24th. Based on turnover limits, they have defined various dates. So there is only one provision, only one section, subsection, which deals with due date. And that is also not directly dealing with the payment due date. It's only dealing with the 3B due date. In 3B, whatever tax self-assessed, that has to be discharged before 20th of the, before the due date of the 3B returns. That's all is told. So the next question that arises is, what will happen to cases which will arise out of assessments? For example, the section 39.7 only talks about payment of the tax as self-assessed in 3B. That's all is a wording which is used there. So if 3B has not disclosed certain taxes, or probably let's say there is some additional liability ascertained through departmental assessments, then what is the due date for those payments is not clearly brought out in 39.7, because 39.7 is restricted to 39, which is 39 is per se 3B only. So there is no other specific section which says that this is the due date in general. So practically speaking, all the assessments are getting concluded practically, whether it's an audit notice or a intelligence notice or assessment notice, practically are going based on the same date only. Just 20th of that month is what they are considering as the criteria. And why that is important, basis that only your interest assessment will flow. And of course, interest liability will change because of that period, maybe few days, few months, but then the interest liability will change as per that. So the question is, what will happen in those cases where, legally speaking, let's assuming if somebody wants to challenge it, can I say that there is no due date for those period, or time of supply, whether time of supply will be the due date in those cases will be a question mark. It's not been challenged except for one cases which we have found out in practically. No other case where even at the assessment level, they have raised this as an issue. Because definitely when the numbers are higher, this value also may go up. So there is no provision which talks about due date for payment of taxes arising out of departmental assessments. So this is somewhere probably the lawmakers may have to address it as it goes along, or as the law is evolving. Yeah.
The subsection 7 which you have referred to, 39 subsection 7, I think you have referred to.
Yeah.
39 subsection 7 reads this way: every registered person who is required to furnish return, etc., under subsection 1 shall pay to the government the tax due as per such return, not later than the last date on which he is required to furnish the return. So that makes it clear. The law itself makes it clear, not later than the last day. He is required to. The date is also mentioned. Why did you say that there is no specific provision for date?
No. We are saying so long.
Further, I also have one more doubt. The proviso also says so, provided that every registered person furnishing the return under the proviso to subsection 1 shall pay to the government in such form and manner within such time as may be prescribed. So is the form and manner for payment is also prescribed in the rules?
Correct. So I'll just address that point. The point which I was communicating is whatever self-assessed tax which we assess it in the return, there is a due date prescribed. We are not saying that there is no due date at all. Whatever tax as determined during assessment proceedings, where it is coming out of the departmental notices and where there is not self-assessed by the taxpayer, we do not find a due date being prescribed for those situations. Specifically with respect to that, it is not saying that whatever GST applicable for a particular month, the due date is 20th. It is only saying that whatever GST as assessed in that particular return, the due date is so and so. So there is an element of gap with respect to those taxes which we pay voluntarily, because there are many cases where the taxpayer pays it after the departmental notices. DRC3 is a form through which they pay it. So DRC3 is not considered as a return for the purpose of section 39. That's a separate form notified under the different section and rules. So the form and manner has been prescribed. We have various forms for payment of challan also. So for the regular tax assessed returns, there is a due date, no doubt, with respect to 39(7). But for departmental proceedings and taxes arising out of that, there is no specific form. I mean, I would say there's no specific due date which has been prescribed in this regard. Still, practically speaking, department is going based on a case where, next year, 20th, next month 20th is the due date. That's how they calculate for interest purposes. But if there has to be a challenge, there can always be a challenge to that particular provision also. Sir, am I answering your question?
Yes, sir. Proceed.
Yeah. So the second issue which had come out, of course, it is related to time of supply. So the next question is, of course, they may either link it to the time of supply, or they may consider any of this. So probably time of supply will become relevant even in those cases where it's a departmental assessed dues. They may consider the time of supply to be the criteria to decide the liability of interest also. That is also another view possible. Or there is also a view that there is no due date. That cannot be a view. That is an extreme view in this regard, because the law cannot visualize all situations. Probably we can see the precedents evolving in this regard. So this is generally the time of supply provisions. So to put it in a nutshell, one, we have a time of supply for goods, which only says you have to raise the invoice before the goods are sold, or on or before the goods are sold, and base is that you pay GST. For service, payment and goods, payment and invoice becomes relevant. And where it is a continuous supply, for example, let's take the example of this continuous supply. There are a lot of examples. We find cases where, as per the contract, I am required to procure cements from somebody consistently. Let's say it may happen over a period of 1 month, 2 months, 3 months, and I might, I might have the bills settled after verification after 2 months or 3 months. So in those cases, there is a consistent or continuous supply of goods. In those cases, the law says we do not wait for every moment, but rather whatever your contractual terms are saying. In terms of agreement, it says every 1 month you will settle. Then consider that as the time of supply. Let's see, take the simple example of the newspaper which is being supplied at our home, or a simple example of the milk cover which is being delivered at our home. So there's a daily delivery happening. Technically, it's the daily sale, but you can't keep rising invoice for every day which is being supplied. So wherever there's a continuous supply under a single contract, where there's a continuous supply of goods, the law says whatever you define in your contractual terms as the date for settlement of these dues, that will be considered as the time of supply. So that is, I just gave a simplistic example. It can also be as complicated as a construction company buying RMC. So in case of ready-mix concrete, there will be a consistent supply of RMC. You can't measure it every day. So in those cases and all where it's a continuous supply, the law gives some leeway. They say you can go based on the terms of contract. So it's also a responsibility to ascertain whether it is a continuous supply or a normal supply. Again, basis that the invoicing timeline will change. 30 days or so is normal case. Here it is as per contract. And also the interest liability, everything will go for a change. So it is important at the first step to see whether it is a goods or service, and is it continuous or not continuous. And if it is continuous, go based on the contractual terms. If it is not continuous, go based on section 12, which says based on sale invoice for goods. Section 13, which says you go based on invoice or payment, whichever is earlier for services. So this is one. And time of supply will define the due date of payment of taxes, which is in general 20th of the next month for self-assessed taxes. For departmental assessment proceedings, it is generally considered as 20th, but then it may evolve over a period of time. And especially for time barring cases, time of supply sometimes may become a boon in other way around. For example, there have been many cases during the transition period between service tax to GST period. Now, we all know for service tax period, the normal timeline is the extended period is also over. 16-17 was the last, 17-18 was the last service tax, July 17. The return filing period was June 17, return filing period was 15 July. So 15th August. From there, 5 years was 2022 is over. So the extended period, even for service tax, is over. Now, for 17-18, GST assessments are going on. You will find a lot of interesting scenarios coming up. One such scenario will be a case where 17-18, first 3 months was service tax period, and the next 9 months was GST period. So wherever there is a reconciliation issue will come up, there will always be a situation where my books of accounts will show only total turnover, which will include the first 3 months of service tax period, next 9 months of GST period, total 12 months. So in this 12 months period, naturally, I will have a breakup of first 3 months and 9 months, especially during the transition period. It's very interesting. That is a case where you have received the advance in service tax period, which is, let's say, June 2017, and the invoice was raised in July 17. At that time, there were rules under even the old law. In this scenario, when advance is received, but invoice is raised later also, the law says based on advance only, service tax has to be paid. So because advance was received in pre-GST period, point of taxation is over, time of supply is over for that. So even if invoice is raised post GST period, because advances has been received prior to the GST period, it will fall under only service tax regime, not under the GST regime. And it will end up going into time barring because it goes under service tax. So this time of supply is quite crucial, especially for the first year, for 17-18. Yes, because of the transition. So there are quite a possibility, maybe on legal point, the department may be having a strong issue. Let's say it may be a case of escapement of liability also. But then during the transition period, there have been some rules, and prior and post there have been rules. It all simply merges to this only. If completion is done before and 30 days is over for completion, then date of completion is deemed as the date of supply. Even if invoice is received later, let's say even if I raise invoice in post GST period, but I have not paid the taxes, but for which completion is already over, time of supply is done. So you can only demand service tax in that case, for which already it is time bar. So there is always a critical juncture, especially for 17-18, where the assessments are now happening and getting concluded, where there is going to be escapement of turnover probably on various scenarios. This transition provisions and time of supply will play a crucial role in ascertaining the actual liability of the supplier. So that may either be a time barring or GST is going to be crucial. And in this regard, time of supply is quite useful. And last point I'll conclude with respect to the vouchers. There is a concept of voucher which has been, it's been kind of borrowed from the foreign GST laws, that let's say, for example, I buy an Amazon voucher. Amazon voucher, I can use it for any purpose in Amazon. I don't know for what purpose I will use it. So when I buy the voucher, I do not know what supply I'm going to receive. I buy. It could be sometimes books, it could be sometimes electronic items, it could be sometimes apparels, etc. So because of that, the law says the time of supply will be the time when you redeem the voucher, basically the time at which you actually buy the final product. Whereas let's say you are buying landmark books, for book voucher only you are buying, where it is absolutely certain that it is only against books and not anything else. In which case, the law says it has to be considered as supply at the time of issuing the voucher itself. Basically, you cannot camouflage an advance by giving a voucher. So where it is clearly ascertainable that it is against a specific product or a service. For example, a designing company gives a voucher. Let's say hair designing company gives a voucher specifically for the hair design services only. Then in which case, you cannot camouflage your advance by saying that it's a voucher. So where the service or product is clearly ascertainable, you go based on the supply of voucher date. Where the product or service nature you will not know at the time of supplying the voucher, then we'll have to go based on the time of redemption date. But then the fundamental issue, whether voucher is a transaction in money or whether the voucher is supply or not, is already been challenged in courts. It's pending for the final conclusions. But as it stands today, the time of supply in conclusions, we are looking at time barring cases, transitional cases, and then also about the due date cases. So probably at this stage, maybe you readers can look at more on section 12, 13 and 14, and especially transitional provisions which are in section 142 of the 140 to 140 and 142. Transitional provisions become quite crucial with respect to the time of supply. People can also have a look at it. Any other inputs or doubts are also welcome. Thank you.
There was few questions in the chat box. I think Mr. Ganapati is there with one question. Mr. Ganapati?
Yeah, I think that question I have addressed that. That is regarding bad debts. So for bad debts, if I issue a credit note also, that will not absolve the liability. That is not a eligible condition for giving a credit note. So hence, in my view, it is still liable for GST. The second question was related to hostel and mess. The present status of GST on hostel and mess run by educational institution for their students. So as it stands today, any services, in fact, by an educational institution to its students or faculty or for the staff is exempt from GST, and hence that continues. So that will be exempt only so long it is from the educational institution to the students. So that will be exempt. The question that primarily came up was, if a third party runs these mess or hostel, what will happen? Was the question that continues to be debated. But then I'll just restrict myself to that particular question. For educational institutions to students, it is clearly exempt from GST.
Any other questions to Mr. Srinivasan? I think we are not having any questions, Mr. Srinivasan. Thanks a lot. You have really taken us through the entire issue of time of supply, and very critically when the payment due to the government is to be remitted to the government account. And I think it will be very useful for all the listeners to be applied in their course of their practice. Sir, with this, we are concluding the fourth topic in this GST series of GST issues. The next month, we are going to deal with valuation mechanism of GST. And for that, I will be circulating the dates of the notice in due course. Thank you, Mr. Srinivasan. Before we go into the next topic, there's an announcement to the Revenue Bar members. We have about a few weeks back, we have circulated one Google form to be updated by the Revenue Bar members for keeping our records of the members updated. I think we have not yet received the entire list of the Google forms from our members. I request who are present here and not done it, please do it today or tomorrow so that we can proceed with the next step in this for updation. Thanks to all. Our next topic for the day is by Ms. N.V. Lakshmi, advocate, on the recent amendments in taxation of charitable trusts. There are quite a few amendments with regard to 11 and 12 charitable trusts, which are having a far-reaching impact. Ms. Lakshmi will deal with all those amendments, and we'll take questions from the floor after her speech. Yes, Lakshmi.
Thank you, Vasu sir. I thank Revenue Bar for the opportunity given today. And I'd like to specially thank our president, Mr. Sridhar, for his encouraging words. I'll share my screen now. So recently in the Finance Act 2020, Finance Act 21 and Finance Act 22 and 23, there were significant amendments in the charitable trust. There were multiple amendments, more particularly in the area of registration, cancellation, and the penal provisions. First, I will deal with the registration amendments. The Finance Act 2020, the registration amendments saw a significant revamp from the years to now. The Finance Act 2020 had introduced a section 12AB with effect from 1/6/2020, which significantly revamped the procedure for which a charitable trust was required to make registration. Earlier, the registration made by a charitable trust was for in perpetuity, but now charitable trusts are required to renew their registration once in 5 years. The 12AB was first introduced by the Finance Act 2020 with effect from 1/6/2020. Later, due to the COVID-19 and other issues that were going on, the said section was scrapped by the TOLA Act and was reintroduced from 1/4/2021. Section 12AB requires registration application to be made, and for the purpose of registration application, they divide the charitable trust into 6 categories. The first category is where trust registered under the erstwhile 12A or 12AA, and second category is provisional registration for first-time applicants, and the third category is provisional registration for commencement of activities based on commencement of activity, and the fourth category is conversion of provisional registration into regular registration. Once we are provisionally registered, every trust is required to convert it into a regular registration. That is the fourth category. The fifth category is trust registered which has become inoperative due to 11(7). And the sixth category is other cases. There were 6 categories that were mentioned, and there were 2 forms that were specified for the purpose. For trusts falling under category 1 and category 6, they were required to file form 10A. And for the other trusts, registration was required to be done under form 10AB. So the 6th category once again saw an amendment with effect by the Finance Act 2020-23 with effect from with effect from 1/10/2023. By the sixth category, by the Finance Act Amendment 23, they divided the sixth category into further two subdivisions. The first subdivision was trusts that have commenced their activities, and the second subdivision was trusts that did not commence their activities. So there were two categories that were put in by the Finance Act 2023. So the time limits for various categories, I will now go into the time limits. For trusts registered under 12A or 12AA, which are earlier registered, the time limit for making an application was 3 months. Originally, the time limit when the Act was introduced from 1/4/2021 was 3 months from the end of the month in which the section was introduced, which is 30/6/2021. But this time limit was extended multiple times by the CBDT, and finally, there was an extension that was given by the CBDT by circular number 6 of 2023, extending the time up to 30/9/2023. So these trusts, they were required to make application in Form 10A to the principal CIT, and the principal CIT was, for all these trusts, he could give registration up to 5 years. The second category of trust is for registration under 12AB and registered under 12AB, and registration is due for expiry. So this is for provisional registration. You are required to make this 6 months prior to the expiry of registration. The third category is where a trust is provisionally registered under 12AB and the provisional registration is about to expire. The trust was required to make re-registration within 6 months prior to expiry of period of provisional registration, or 6 months from the commencement of activities, whichever was earlier. Next category was where trust has become inoperative due to the first proviso. They are required to make registration within 30 days in which they become inoperative. The next category is if I make changes in my objects. Within 30 days from the change in my objects, I was required to make a re-registration. And the last case, in other cases, like I told, there were two subcategories. The first subcategory is not commenced activities. When a trust has not commenced its activities, the subsection 6 of 12AC1 says registration has to be made with at least 1 month prior to the commencement of the previous year relevant to the assessment year from which the said registration is sought. Subsection 12A2, which says registration could be given to a trust from where application is made on or after 1/6/2011. Provisions of section 11 and 12 shall apply from the assessment year immediately following the financial year in which application is made. Like it is seen, there were difference between 12AC1 clause 6 and 12A2. Due to the time limits, the CBDT in its circular number 6 of 2023 has, in order to bring in consistency, they have explained that the provisional registration shall be valid from assessment year relevant to the previous year to which application is made and shall be valid for a period of 3 years. The next issue that will come up is in case of an SSC that has not commenced activity, what is the timeline under the Act for registration? The Act does not specify any time limit. Depending on the provisions from which year the assessee wants the registration, they should be making an application. 12A2 says if I make an application in that particular financial year, it is applicable from the assessment year in which I make the application. Once I make an application, the CIT can consider my application and pass an order. In case of applications made under subclause 1, he can pass an order with granting registration for a period of 5 years. In case of subclause 2, 3, 4, and first clause of 6, the CIT can call for documents, verify, and if he is not satisfied, the CIT has the power to reject the application and also initiate cancellation. In case of provisional registration under clause B of 6, the CIT can give a provisional registration for a period of 3 years. So what is commencement is not defined under the Act for the 6th clause. Whether commencement will be period from which the trust is formed, or whether it will be a period from which the activities of the trust commence. The activities commence is when I get my donations or make an application. There is no clarity on that. The next issue that will come up is in case of direct registrations. Now trust can make direct registration, and there are 2 conditions that the Act prescribes in clause 6B. It says if I have to make a direct registration, I'm a new trust and I've commenced my activities and I can make a direct registration. There are 2 conditions. The trust says I should not have claimed the benefits of 11.1023C earlier, and that is the condition that is given. So the issue now arises in respect of an organization where it had a registration and that was later cancelled. What will happen to such an organization? I had been having registration in the past. I have been claiming benefits of 11.1023C or as the case may be, and my registration had got cancelled. What will be the effect? Will I be entitled for registration now? Because I will be out of all the 6 categories that is mentioned. I will not fall under any of the categories. What will happen to the fate of these organizations where registration is cancelled? That is one question. The second issue is I am an organization. I make an application for provisional registration. I get provisionally registered, and I fail to get the renewal of registration, or after 5 years I fail to get renewal of these registration. What will happen to me? I cannot make re-registration in any of these categories. What will be the fate of these organizations? We will have to see. Next we will go to provisions of section 115 TD. 115 TD was amended by the Finance Act 2023 with effect from 1/4/2023. The section was amended to, and it is popularly called the exit tax, and it was amended to tax an institution which has converted into a firm which is not eligible for grant of registration under 12AA, 12AB or 1023C. When once such an institution gets converted into such other form, 115 TD says, apart from the tax that is to be levied on the institution, under 115 TD, taxes will be levied at maximum marginal rates. So, under subsection 3 of 115 TD, deems situations where a specified person has been converted into a firm not eligible for registration under 12AA or approval under 1023C. It says registration where registration has been cancelled. If my registration is being cancelled, I will fall under 115 TD. Where I have adopted a different object apart from the object for which I was registered, and I failed to make an application before the commissioner for re-registration or intimate him about the object, or I make an application, I get rejected, then I will fall under 115 TD. Or where I fail to make an application for re-registration or renewal. Once I do all these, I will become an entity that will be covered under 115 TD. This would simply mean any small institute, a trust that misses its deadline for after 5 years to make a renewal, they will immediately be an entity covered under 115 TD, and they will be penalized with the 30% maximum marginal rate tax, and this will be very harsh for very small institutes. So what is the liability under 115 TD. The liability under 115 TD is taxed at MMR at 30% apart from the regular taxes. When is the liability arising under 115 TD? It arises 14 days in case of a registration, in case of an institute where registration is cancelled, 14 days from the expiry of the time limit for which the appeal against the order cancelling registration is passed, or where appeal is filed, once the appellate order confirming the cancellation is passed, 14 days from then. In case of modification of object or failure to comply with the renewal, it is 14 days from the end of the previous year. These are the amendments that have been brought in by the Finance Act 2023. The next amendment is, so like I told, there are multiple dates for the trust to make registration. The registration dates were constantly expanded. It was originally introduced by the Finance Act 2020 and then scrapped, introduced by the Finance Act 2021. There were 3 board circulars extending the time limit. And many trusts have missed these deadlines. And once the Finance Act 2023 introduced 115 TD, the trusts made a representation to the board stating, look, for this genuine mistake from our end, we will be penalized on such a big thing. Based on the representation received for mitigating the genuine hardship, in the circular number 6 of 2023, the board had clarified that where the trusts make application within the extended time, and that is on or before 30/9/2023, for such trusts, this section of 115 TD will not apply. However, if you go through the circular 6 of 2023, time limit was extended for Form 10A in respect of Form 10A and 10B in respect of 12AA. However, for ATG, only Form 10A time limit was extended and re-registration 10AB time limit was not extended by the circular. So the fate of institutes that have missed the deadline for re-registration under ATG contains similar identical provisions as that of 12AB, where under ATG they have missed. The board circular is not of much use to those institutes. And in my view, the said institutes miss their ATG registration forever. The next issue is on cancellation of registrations. The power to cancel under the old act and the new act is almost similar. The CIT is given powers to cancel registration where there is specific violation that has taken place. Additionally, in the present provisions, Finance Act 2022 has removed the power of CIT to cancel registration for violation of provisions under 13(1)(c) and 13(1)(d). Earlier, the CIT had the power to remove violation under 13(1)(c) and 13(1)(d). But presently, those powers are removed. So when can the cancellation be done? Cancellation powers are under 12AB(4). So when the and one more amendment that came in 2023 is, prior to that, only the regular registration can be cancelled. 2023 amendment says now the provisional registration and regular registration can be cancelled. So when can the cancellation be done? Where the CIT notices one or more occurrences of specified violation, or where the PCIT received reference from the assessing officer under second proviso to 143(3) and case has been selected under the risk management strategy. These are 3 circumstances under which, under 12AB(4), the PCIT can proceed for cancelling the registration of a trust. What is specified violation? The specified violation is defined in the explanation to 12AB(4). Specified violation means in case a trust applies its income for purposes other than its objects, that becomes a specified violation. In case a trust has not maintained separate books of accounts in respect of its business income, then that becomes a specified violation. In case income from the property of the trust has been applied for a private purpose, then that becomes a specified violation. The next specified violation is activity not genuine or in accordance with the object. And whether if the trust does not comply with any other provisions of the act, then that becomes a specified violation. And the last specified violation that was amended by the Finance Act 2023 is the application considering incomplete or contains false or incorrect information. The last violation appears to be pretty draconian. It gives the power to the CIT to cancel an application in case it contains incomplete, false or incorrect information. Assuming a trust genuinely makes an error while filing the form, will that give power to the CIT to cancel the registration? The section is worded like this. The section says the CIT can, where he notices a specific violation, he can pass an order cancelling. So once he notices there is an incorrect violation, which is a specified violation, in my view, the CIT can go ahead to cancel the registration. But for bona fide errors, very small errors, genuine errors, the CIT should exercise its discretion to not cancel all these registration unless the object of the trust itself has failed. Otherwise, this will lead to unnecessary litigation before the appellate forum. The next issue is whether non-renewal of 12AB, I am required to renew it once in 5 years and I don't renew it, whether the CIT has the power to cancel my registration for this offense. Once I do not renew my registration, I will fall under 115 TD and I will be liable for the exit tax. Therefore, the CIT need not even cancel my registration. I will fall under the exit tax and I will have to pay the exit tax. And there is no means by which I can come under 12(1) AC to make a fresh application. Therefore, once I am not renewed, there is no need for cancellation per se. The next issue that would arise is whether rejection of an application by the CIT for renewal or fresh provisional application would automatically amount to cancellation. 12AB provides that at the time of renewal, the CIT has the power to reject the application and cancel. But whether at that stage itself he can cancel the registration or a separate proceedings for cancellation of registration has to be initiated, because the cancellation mechanism specifically requires an opportunity of being heard to the assessee before cancellation. That is another issue that is there. In my view, the CIT, since he has the power to reject and cancel the application, at the renewal stage itself, he can cancel. While passing the rejection order itself, he can state in the order that I'm cancelling your application, provided he gives a show cause notice right before rejection saying I'm also proposing to cancel your registration. The next amendments that came are in respect of corpus donations. Corpus donation, Finance Act 2020-21 had brought in multiple amendments. 11(1)D was amended, stating that corpus donation received by an assessee should be invested in mode specified under 11(5). Now, every corpus donation I receive, I should specifically reinvest it in the mode specified under 11(5). Assuming I'm a trust and I receive corpus donation, say for a particular project, say for a long-term educational project of building classroom, upgrading my classroom facilities. If I do that and I spend that money towards the upgradation, whether I would have violated this section, yes, the section specifically requires you to invest the monies in mode specified in 11(5). An application from corpus that does not meet the specific condition would not be treated as an application. The next amendment that was introduced was Explanation 4 to section 11 inserted by Finance Act. Explanation 4 to section 11 says that once I spend out of corpus during a particular year, in the year in which I spend out of the corpus, it will not be treated as application of income, but only in the year in which I replenish the corpus amount, in that year, it will be treated as application of income. For example, I have donations of about 10 lakhs in year 1, and I spend 12 lakhs in that year. The 2 lakhs that I spend out of the corpus will not be treated as application of year 1, and it has to be treated only in the application of the year in which I replenish the corpus. There are further conditions for claiming this in the subsequent provisos. So the second proviso, the first proviso says it will be claimed only in the year of replenishment. The second proviso has the following conditions. It says, subject to these conditions only, even in the year of replenishment, I will be entitled to benefit. It says I should not have spent it for other than charitable purposes. I should not have violated the TDS provisions. I should not have violated 48(3) provisions. And I should not have invested in other than specified modes. If I violate any of these sections, then I will not be entitled as per the second proviso. The third proviso was also amended, which gave a specific time limit before which I should replenish the corpus. I should replenish the corpus within 5 years. If I take beyond 5 years for replenishing the corpus, even if I replenish the corpus, I would not be entitled for the application. The fourth proviso was inserted by the Finance Act 2021 that said these restrictions in the previous provisos will not apply in respect of an application made on or before 1/4/2021. If I make an application out of corpus before 1/4/2021, the above provisos will not apply. What will happen to a case where before 1/4/2021, I spend out of the corpus and I was not able to replenish the corpus before this amendment began? Then in that case, I would not have claimed application in the earlier year when I got it out of the corpus. And in these provisos, which say in the year of replenishment that I am entitled for application, that I will not get, I will lose out the entire application. And in effect, I would have eroded my corpus. These provisos were inserted only to avoid double claim, but in effect, for a genuine trust that has not claimed the exemption, the corpus becomes eroded. Similar provisions are also inserted in respect of application out of loans. Where I apply out of loan, it is not considered as an application. It will be considered as an application only in the year in which I repay the loan. And all the other conditions for which corpus conditions are there, similar conditions have also been amended with regard to the loans. The next amendment that came is inter-trust donations. There was an explanation 4.3 that was inserted to section 11, which said only 85% of donations to eligible institutions which were registered under 12AB or 1023C will be applicable. So the question here is, if I make an application or donation to an unregistered trust, what will happen to that? Will I be eligible for 100%? There have been case laws in the past which said just because donation is made to an unregistered trust, that cannot be treated as not an application. Now, will I be eligible for 100% or will this amendment say I will not be entitled at all, or is there a cap of 85% even in respect of those other donations? That is something that is not settled. The next issue is in respect of explanation 3A and 3B were other explanations that were inserted by the Finance Act 22. with retrospective effect from 1/4/2021. So explanation 3A and 3B is in respect of religious institutes. In these amendments, give an option to the trust to apply some portion of their voluntary contributions as corpus donations. These trusts, the amendment is specifically in respect of religious trusts that are receiving some for the purpose of renovation or repair of temple, mosque, gurudwara or church, as the case may be. Even in the condition specified is that the corpus should be applied for the purpose of the trust, and it maintains a separate identifiable account and invests in mode specified. And if there is any violation in respect of the conditions, explanation 3B says in the year of violation, it will be brought to tax. Next amendment is 115 DBI. 115 DBI was introduced by the Finance Act 2022 with effect from 1/4/2023. 115 DBI says, in case of specified income, the said income will become chargeable to tax at maximum marginal rates. So like all the other 115 sections, certain incomes of the charitable trust were brought to tax under the maximum marginal rate without any slab limit or set off of expenses. Prior to 115 DBI, there was no specific section saying that charitable trusts should become taxable at a specific rate, and they were taxed under 164(2). What is covered under 115 DBI? Any shortfall below 85%, it is covered under 115 DBI, provided I file the required form 9A or 10, as the case may be, for accumulation of funds. And the second issue that is covered is deemed income referred to in section 11(1)(b). The next is deemed income under 11(3). And where impermissible investments are made, violating section 11(5), those are also covered under 115 DBI. Income applied for the benefit or interest of person, application made outside India is covered. All these are covered under 115 DBI, and once I am covered under 115 DBI, I am liable to pay on the specified violation sum tax at maximum marginal rates at flat 30% without any rates. So what happens to violation under 13(1)(c) and 13(1)(d)? These amendments are still covered by 164(2). But in addition to the maximum marginal rate, for violations under 13(1)(c) and 13(1)(d), a penalty provision is brought under 271 AAE, where it says, in case of penalty for the first time offense, it is charged at 100%, and in case of further offenses, it is 200%. Penalty is over and above the penalty that is leviable, and this penalty is not covered under 273B. Therefore, taking a stand that there's a reasonable cause for such failure will not apply for 13(1)(c) and 13(1)(d) violations. The other violations that are seen is violations covered under the newly inserted sections 13(10) and 13(11). 13(10), these violations are covered under 164(2). So these violations says the commercial receipts are less than 20%, where I do not obtain audit report, I do not furnish the audit report, non-filing of ITR, non-maintenance of books. In these cases, under 115, under 164(2), I will become taxable. The income, however, due to the amendment in 13(11), now the amendment says, no, although 13(8) says I am denied benefit in respect of 11 and 12, then other expenses and income is only charged on net basis. I will not be charged at gross, I will be charged only at net basis. And for these provisions, 40A3 and 40A1A will apply, and wherever I have not complied with those sections, I will be given those specific disallowances. Other amendments that have come is the second, third, and fourth proviso to 12A2 was deleted, by the Finance Act 2023 with effect from 1/4/2023. These provisos were in respect of the retrospective amendments, where the trust was given benefit of registration to the earlier years in respect of pending assessment, and there was also a proviso that said reopening will not be made in respect of registration. On account of registration, those benefits are now removed by the Act. The next amendment that was brought in is Form 9A and Form 10. Now, they were originally required to be filed along with the return of income. Now they are required to be filed 2 months prior to the return of income date. The next is the Finance Act 2022 brought in multiple amendments that require me to maintain additional books of accounts and documentations, and Rule 17AA was brought in. And there was an explanation to 11.7 which said application of expenses is to be made on cash basis. And further, in respect of updated return, in respect of an updated return, that the assessee cannot avail 11 or 12. That amendment is also brought in. So if a trust is going ahead to make an application, to make an updated return, it will not be entitled for the benefit of Section 11 or 12. These are broadly the amendments that came in Finance Act 2021, 22, and 23. Any additions from the audience is most welcome.
Questions from the participants?
Good evening, Suresh.
Yes, Mr.
Taylor.
Suresh.
I'll just take a few minutes regarding this disallowance of 40A3, 40A1A.
Yes, sir.
The Act says, the disallowances will be to the extent of reducing the application.
Yes, sir.
It doesn't say that it should be taxed separately. But if you see the form, ITR form, it separately taxes at 30%. I think the rules go against the main objects of the Act. I think this is not correct. I think something should be done on that issue. Second is the Foreign Contribution Regulation Act. Some FC receipts are made. They are for specific purposes, for construction of church or something like that. And those amounts cannot be spent. They are kept in separate bank accounts and then spent subsequently. Will it go to affect the? Will it amount to corpus donation, and it has to be kept in the specific deposits? I think there seems to be a dichotomy. And thirdly, the filing of Form 9 and Form 10. You have to make it before 31st August. Does it apply from this year or from the next year?
The form, sir, it applies from this year, assessment year 23-24. But if you look at the board circular has given a relaxation to that effect to say that even if you file the forms along with the return of income or little before the return of income, then the denial of 11 and 12 need not happen. To that extent, there's a relaxation in the circular, sir.
Okay.
And in respect of the contributions received by religious institutes, they should still be kept in specific deposits specified in 11.5.
No, I understand, but they have to be spent for those purposes.
That appears to be a problem. On one end, they say you should keep in the deposit specified in 11.5, and on one other end, they say you have to spend it. Whether you have a fixed asset and also a deposit.
It's not possible.
That is how somebody is going to make that compliance. I'm not sure, sir.
Okay. What about the audit report to be given Form 10B and 10BB now with differential receipts? Up to 5 crores, it is Form 10BB, and beyond 5 crores, it is going to be Form 10B. Will it apply from this financial year? Because it says the notification came in February 2023. It says effective from 1/4/23. Will it be for the financial year or for the assessment year?
It will be for the assessment year, sir.
Assessment year 23-24.
Yes, yes, sir.
I think it's going to be a tough game for everyone.
Yes, sir.
Thank you.
Yes, I have a question, sir.
Yes, sir.
This is Tarun. Can I hold simultaneous registration as a charitable trust in terms of section 12A as well as in terms of section 1023C?
So there is also a specific amendment to this tune. You cannot have, although you will be registered under both, there is a specific amendment in 11 that says once you are registered under 11, you cannot claim benefits of 1023C. And notification under 1023C will not be effective from the date you get registered under Red 12AB. So now simultaneous benefit is capped. That cannot be done.
Okay, ma'am. What will be the computation consequences in terms of section 11 if I'm filing my return as well as my audit report belatedly? The computation consequences.
The computation consequences, you will be making that specific violation by filing your return not in time, and therefore you will, the 30% MMR will apply.
One last question, ma'am. What is there any requirement of a prior approval before dissolution of a trust by handing over my own properties to another trust having a similar objects?
This question, I would request somebody else to assist me on this. I'm not sure of the answer here.
Sir, can you repeat the question, sir?
Yes, sir. Whether any prior approval is required for the dissolution of a trust by handing over the properties of a trust to another trust having similar objects.
In fact, the approvals of the CIT in the past have been, to take prior approval for distribution of assets, even on closure or dissolution. When you transfer the entire assets to another trust which has got, or another institution which has got similar objects, prior approval is required. That's one side. Even otherwise, for if it involves immovable property and all, under 93 of CPC, you have to approach the court as well.
His fundamental question is what I could understand. Is there any statutory mechanism under the Income Tax Act for getting a prior approval? Ms. Lakshmi?
The condition for registration, in fact, at the time of registration, one of the conditions that the department looks for is whether there is a clause for transfer. They give at that time, the original registrations do come with a condition saying that prior approval will be sought from the commissioner.
But that is not statutorily prescribed.
Yes.
Power CIT.
Yes.
Is it not stretching their powers beyond the scope of the Act? Ms. Lakshmi? I'm not.
You
Sir, I will have to look on this.
Not from Balaji.
We are on different lines. Yes, it appears to be stretching beyond, but department looks for it.
Any other questions?
One more thing is, any change in the assets, does it mean only immovables or movables? It has to be, intimated to the department.
Change in sense?
Change. Like, suppose you sell a property, you have to intimate, or you.
No. Nothing.
It seems to be
on sale of property, department is not required to be intimated. Certainly not.
No, if
But
I remember,
since it's a public charitable property,
yeah,
to ensure that it comes with the fair price, etc., the safeguard is made through the civil procedure code, where you will have to approach the civil court for getting its permission for the transfer of immovable properties.
No, that's only when it is provided in the trust deed. Only in Bombay, where you have the registrar of trust, I mean, commissioner of trust, where you have to take permission for any of those things. I think Tamil
No, no,
Nadu, it doesn't happen.
Tamil Nadu, there is no charity commissioner like Bombay.
It's not there, and
But
I
that
think there is no way, there is no bar on transfer of any property. Only income tax people, I think they have been making some issues.
No. In fact, there is a trust which you may be aware of, Demonto Trust.
Yes.
One of the trustees was, if I'm right, Mr. JCD Prabhakaran, former MLA.
Yes.
He sought to transfer one of the properties of the trust as a trustee to himself for a consideration.
No.
The court rejected it on the ground, saying that it is not fair market price. So the approval of the court is required not under the Income Tax Act, but under the civil procedure.
Okay.
This is to protect. No, the public property is a charitable trust is a public property and managed by the trustees. That the trustees, even if they transact at arm's length, is to be ensured in the public interest. That's why this procedure comes.
So as regards the dissolution, since at the time of registration, one of the condition is that there should be a clause stating that on dissolution it should be transferred to another trust. So that clause, once it is accepted, I don't think separate approval is required for that.
So one more point which I want to add is, in the context of section 115 TD, there is one specific clause which says that if the trust property is transferred to another trust of similar objects which enjoy exemption under 12A, I think you will not be hit by the exit tax. So that way,
Yes.
I think that way I think they are trying to bring in at the time of registration itself, ensure that that clause is there. So in my view, I think it's not an exaggeration of the act, where the act itself requires you to ensure that you have a clause there.
In fact, regarding the transfer of assets, may I take one more question on that, please?
Yes, continue.
The section 13(2)(f). It says, transferring its assets to interested parties unless such transfer is for adequate consideration. There is a prohibition. And one of the conditions, Form 10AC says, no asset shall be transferred without the knowledge of the jurisdictional commissioner of income tax, including any trust society, non-profit company, etc. So in this situation, it talks about assets. So asset means, is it only immovable or any other asset? So even if you withdraw a FD, should you intimate the jurisdictional commissioner?
Sir, the last one, which one did you refer, sir?
Form
Commissioner's approval.
13(2)(f).
That's for inadequate consideration.
Inadequate consideration, yeah. It says, if any share, security, other property is sold on behalf of the trust or institution to any other person referred to in
Referred to in clause 3.
3 during the, yeah.
So that's only when it is sold
to
a person mentioned in
Okay.
13(3),
So-
and that too for an inadequate consideration.
Okay.
I have one doubt in the context of circular 6.
Yes, sir.
Can I just take it up?
Yes, sir.
Yeah, see, the first circular number 6 on first point gives us time till 30th September 23 to make an application if we have missed the bus.
Yes.
The same circular second point says that it will be only applicable from the financial year in which the application is made.
Yes, sir.
So my point is circular 2, point number 2 trying to overtake point number 1. So the main agenda of giving you a relaxation is because you have missed the bus, you are given an opportunity. That way, the board is giving you an opportunity to comply with the law which you missed it. At the same time, in clause 2, they are restricting it only to the year in which you make an application. Say, for example, assessment date 21-22 and 22-23, I missed the bus. So I will be deprived of the exemption which is otherwise available to me as per clause 1 or first point of circular 6. Can you just throw some light on that?
So here, for the 2 years that are interim, the trust will not, in my view, be having the benefit of 11, sir.
Yeah, that's my point. So when the act gives you a leeway to comply with the provisions of the law by giving you an extended time limit, why have they deprived it by another circular point in the circular? So the main purpose of giving you a relaxation is lost, is what my humble view.
Did not look like Lakshmi. Can you share the circular?
The circular. 1 minute. That's I am not able to share my screen.
It's all. I think
fundamentally, I'm Sridhar. Fundamentally, circulars are issued only for the benefit of the taxpayer. If you say that the so-called circular is not friendly to the taxpayer or it is opposed to the statutory provision, according to me, it has no binding value. That is the first argument which one can put forward.
Unit. இது வந்து compressor. நாராயணன் கூட அப்புறம்
This is the place where Girish sir referred. It says it shall be effective from the assessment year in which the application is made, although the first point gives extended time.
Yes, precisely my point is AY 21-22 and 22-23, where the trust has missed this bus.
Yes.
By complying with the circular, still they are deprived of benefit of 11.
In fact, it is granted from the said assessment year.
Yes, that's the point, sir. So if I make an application
being
now,
granted.
So it's granted from 23 only.
From the year in which I make the application.
Yes, so I make an application now. It will be from 22 rather assessment year.
Yes, it is from assessment year 22-23 only they are granting.
So that's the point, sir. So when I missed the bus initially, when the act was amended in 2020 and later pushed by Finance Act 2020.
Precisely 14-21 onwards only it came.
Yes. So that
means from assessment year 22-23. Up to 31-3-21, you would have had the registration under the old S12 regime. From 14-21, you have missed it, in respect of which you filed the Form 10A now.
There will be, in between 1 year, there will be.
One year is lost, no, sir.
1 year is
not lost.
It is lost. 1 year is lost.
That's the point, sir.
Right. Okay. Right. Thank you, sir. Lakshmi, you have done a wonderful job.
Sir, I have one question.
No,
sir.
I think we are out of time, sir. We can have it in the next session because our time schedule is going to be over now. You have to conclude the program.
Okay, sir.
Thank you, sir.
Thank
I thank Ms. Lakshmi. Your presentation was simply wonderful. You have taken us through all the amendments in this the last 2 years, 3 years, and this requires in fact, this 11 and 12 requires a very elaborate session. It is half a day seminar. We'll, as of now, this is what is possible, and Lakshmi has touched upon all the issues. Thank you, Lakshmi. Regarding our next month's program, I'll be in touch with the members at the earliest. Thank you all.
Thank you, sir. Thank you, Lakshmi.
Thank you all.